Good morning, everybody, and welcome to another Wynniatt-Husey short seminar on taxes. Today we're going to concentrate on inheritance tax and for the small business. This follows on from the one we had earlier, which was inheritance tax in general. For those people who have missed it or haven't seen it, it is available if anybody wants a copy of it. But I will recap the basics of inheritance tax. If we just go through what the things we're going to cover. So inheritance tax for the small business. We're going to do a quick inheritance tax recap. We're going to look at what business property relief is. We're going to find out the gifting rules within the business property development and how it works, and some of the pitfalls. We'll have a quick look at farming, farms and farming, only because it's slightly different. There is a little bit more release on farming, but I mean, they do work together, business property relief and agricultural property relief. They do work hand in hand, but it would be useful just to go through some points on farming and farmland. Then we're going to have a look at the farmhouse. Again, this is specific for agricultural business relief, and then we're going to have a look at the excluded items, items that you can't get business property relief on, and then any questions at the end. Currently you'll all be muted, but at the end Kelly will push a button and you can come in and ask some questions at that point. So inheritance tax recap. I'm just going to run through basically quickly the rules and what you can get relief on. So what happens at death is the whole estate gets valued, and that's the value at date. And then we take off. So we have the gross assets less anything that you give to your spouse or legal partner is outside the scope for inheritance tax. So we take that off the pool. And then any gifts within the guidelines, that's the £3,000 a year gift, £5,000 for people's weddings, £250 for birthdays and holidays and Christmases and that sort of thing. We take all that off. Any gifts that you've given over 7 years, if you've given them into trust, then that might not be the case. So if you've given assets into trust, then we have to have a look, because that can trigger and go back for many years. But all of the gifts that you've given, once they're over 7 years, they're outside your inheritance tax taxable situation. If you've given gifts within the years, within 7 years, then some of it could be exempt on a sliding scale. But it would have to be a gift higher than your personal allowance, because they put your gifts against your personal allowance first. But then after 3 years, it's 20% per year on a sliding scale of any gifts. Your personal allowance, so £325,000 is allowed. Main property relief, that's up to another further £175,000, providing the share of your house is up to £175,000, and it is going down the line, so it's going to either your children or your grandchildren or adopted children. If you're going to a wife or other members of your family, then you won't get the main property relief. If your spouse died before you, any allowances they didn't use, either their personal allowance or their main property allowance, you're then entitled to use in your estate as well. And then the one we're going to talk about today, which is a very important one, which is the business property relief. And then everything above that one, agricultural property relief, anything above that is then taxable. Okay, so at 40% under current rules. So business property relief. Okay, so as I say, we're going to concentrate on business property relief and agricultural property relief. And basically, essentially, you can claim up to 100% of the worth of the business, your share of the partnership, or shares in a company, providing the company isn't listed. But we'll look at those listed ones in a moment. But providing they're not listed, so you've got shares in a company, or you've got a business, then you will be able to claim up to 100% of the value of that asset at the point of death. So as I say, the business is valued, it goes into your pool, which we've just looked at, and then that comes off as a relief. So if your main assets is your business, then this is a very, very good way of being able to pass taxes on. And if you're going to retire and sell your business, then you may want to think again, because of this wonderful allowance that we've currently got. Okay, so the business, it needs to be trading, and 51% or more of its assets needs to be used in the business of trade. 51% of your time, 51% of your profits need to be earned in order to get inheritance business tax relief. And it's either you get it or you don't get it. So you don't get 49% of it disallowed. So if you've got a terrace house in there, but you've still got the factory unit and everything else, then you will get it. You'll get the whole 100%, even though you've got an asset in there that doesn't actually or wouldn't normally qualify. So that's a very important rule that, if you've got a terrace house in your limited company, providing it's less than 51% of your asset value, time spent and profits, then that will get 100% relief, although it's a buy-to-let and it wouldn't normally get relief. Okay, but what you've got to watch is that it's 51% for inheritance tax, but it's only 20%, 80% required for normal taxes. So if you decide to sell your company for entrepreneurs relief, or you liquidate the company, or you try and pass your assets on, and then you can't pass your assets on unless you've got 80% trading. So the two rub against each other, and it is something you need to watch. So the business needs to be trading, or the shares you hold in a limited company needs to be trading, and you needed to hold the business for at least 2 years. Okay, they'll get 100% relief, providing that the assets are owned by the business, the partnership, the limited company. If you own the property outside, i.e. it's a farm and you own it and somebody else, your family farm it, or it's a factory unit and you own it and the company rents it off you, you'll only get 50% relief. Okay, so the only way of getting 100% relief is having it in the company itself. So obviously, if you've got assets outside the company and we've got an inheritance tax problem, we may want to have a look at putting them into the company or including them at some point, or dissoluting the company and putting the trade back as a sole trader and putting it back into the business or the partnership is something that we may look at. But I mean, you've got to weigh up current taxes against the inheritance taxes for doing that, because there may be stamp duty, capital gains tax, and for trying to unwind it. So the things that you won't get relief on if it's in the business is mainly cash. If you've got items in there that are not needed, so this isn't things like your terrace house, this is things that are specifically excluded, which is books of cash. If you've left lots of cash in your business, then they will disallow them, and they will only allow what they would determine as the surplus required to continue running the business. Okay, I think we've got that more on the property slide. So I'll show you an example of that. Okay, so small plumber, turnover £60,000, doesn't pay wages, doesn't have debtors, cash only business, but because he hasn't sucked the money out, he's got £100,000 sitting in the bank. The Inland Revenue would say that's not required, and therefore that would get 100% disallowed. So the plumbing business would be exempt, but the cash would fall back on the inheritance tax as if it's your cash. Okay, so you have to be careful about hiding cash. I'll show you another one, which is a limited company, an engineering business. These are all fictional, but an engineering business worth 200 million, has debtors and wages, and has £500,000 in the bank. The HMRC would insist that anything that's not required for the next 3 months of trading would be surplus. It is a bit of horse trading. It would be up to us to try and show what the business required. You know, if you was in the middle of buying a property, then the cash would be required, and therefore you could argue it. But you know, if it's in there and nothing ever happens to it, then the HMRC will disallow cash. And I would imagine in this case, we would argue probably 150,000 is required to cover debtors and wages and VAT and corporation tax and things like that. And you'd probably find the other 350,000 would be disallowed for inheritance tax purposes. So we are getting through this quite quickly. Although it's not a large case, a large item, it is a very important item of inheritance tax. So gifting, this is when you gift assets out of your company or the company. Okay, so we're going to have a look at, you know, trying to give away the family business or the farming business, or both the same, and what you can and you can't do. Okay, so you're allowed to, as providing that you would qualify for inheritance tax at the time of your gift. Okay, you could hold the gain over, okay, and therefore pay no capital gains tax. But let's see if that works. So yes, so you would be able to hold the gain over and pay no tax in your lifetime. So if we're going to have a look at some examples in a minute. So if you gave away the trading business or part of the trading business or shares in the trading business, you could apply for an inheritance tax holdover relief, and therefore your next of kin or whoever you hand it over to, they wouldn't pay any tax on it either, and they would get it at the value you originally had it for, and that's something that you've got to be careful for. But certainly, you know, if you were trying to allow somebody to come into a partnership and giving them shares in your company or shares in your partnership, then this is a way to do it. And you simply gift them their share of the business, bring them in as a partner, gift them their part of the partnership, and then you hold that gain over, and therefore it wouldn't contribute to capital gains tax. And providing they still own it at your death or after 7 years, it won't get inheritance tax either. But it's got to still be a trading company at that point. Okay. Let's see if an example gives you little bit more details. Okay, so Mr. Green, the grocer, has 2 shops and has traded for many years. The shop is, when he purchased them, they were £50,000 each, and they're now worth £500,000. He decides to give one shop to his daughter, Sally, at £500,000, and he can hold over the gain for £450,000. So there's no tax at the point that Sally gets the shop. He then dies within the 7 years, and providing Sally is still using the shop for business purposes, might not be a greengrocer's, but as long as it's a business asset, then the estate won't pay an inheritance tax on it either. Okay, so I'm going to have a look at the advantages and the disadvantages. So the advantages is it's quite useful to be able to pass assets on to the next generation without having to sit around years waiting to die in order to pass them on. It's very useful for people that want to retire and want the next generation to go on and get the business, but don't fancy checking out just yet on the inheritance tax. And if in Sally's case, she wasn't trading at the end of 7 years, and he dies before 7 years. If he dies afterwards, we don't care. But if he dies before that, then the gift is at the value that he gave it to her, not at the value when he dies. So if he gave her a shop worth £500,000, I think I've got a couple of gains for this. If he gave it, so there's a gain here. Look, so if Sally's shop was demolished and sold for a building plot for 2 million, the inheritance tax would only be on the 500,000 she originally transferred the value to her at. So the estate would still have to pay inheritance tax, but only on the 500,000, not the 2 million. So that's a good advantage if you're trying to get assets away and you think they're going to go up in value soon, and you don't think you're going to last the 7 years. Then this is a good way of doing it. Disadvantages, well, the main disadvantage, of course, is once you've given something away, you've given it away, and lots of people don't want greengrocers businesses. They'd rather have Aston Martins or something. So once you've given the business away, the most important one, though, of course, is that if you gave something away, it's the value at what you originally owned it. So in this case, in the greengrocer's case, you give it away at 50,000. So when Sally came to sell it, it would only be worth 50,000 for capital gains tax relief, and she would have to pay the rest of the capital gain. If she'd have waited until your death, then she would have got it valued at £500,000, and that would be the starting value for her if she was going to then sell it on. Okay, so you need to be very careful when you're looking at giving assets away. Is what do we intend to do with them in the future, and is there going to be some large capital gains, especially if it's a farm and you're going to gift it away, but you think they might be selling it in 10 years' time, then waiting for death may be a better thing. It depends on how soon you're going to die. But yeah, very, very careful things need to be thought about. Are we going to dispose of it soon? And do we want to get it out of your hands? So therefore, the people you pay less inheritance tax. And don't forget, inheritance tax is 40%. Capital gains tax is 20% currently. Or do you want to pass it on to the next kin at a higher value and therefore use the inheritance tax trick of passing it through a will? Okay. So, as I said, we're just going to touch on farming and farmland. Won't be long, but it is worth knowing. So, the farmers and landowners get agricultural property relief on top of business property relief. Okay, and it would be on all the agricultural property, but it's only on the agricultural value. So as it says in there on the slides, if your barn is worth more than its agricultural value, then you may have to pay inheritance tax on the difference, unless we can claim business property relief on the uplift. Okay, but certainly on the agricultural value, you will get agricultural relief. Okay, and the relief splits into two sections. Okay, first of all, it's farmer occupier, i.e. the person or the partnership or the family are carrying out part of the farming on their own land, and the other is the owner is the landlord, okay, but they let somebody else farm it or use it for agricultural purposes. Okay, so occupier farmer, they must have the assets for more than 2 years, and they must use it for either directly or indirectly for the human consumption. So as it says there, if you grow hay and you have it for feeding cows, cows make beef or milk, then you will get your agricultural relief. But if it's for horses, for your pleasure, then you won't get any relief at all, both agricultural or business property relief. They will both be disallowed. And it's on everything. If you can get agricultural property relief, it's on the farm buildings, the farmland, the stock, the assets, the driving vehicles, everything, the cows themselves or sheep, and even the farmhouse in certain circumstances, and we'll look at the farmhouse in a short while, but you could get up to 100% relief on the farmhouse as well. Okay, so this is why agricultural property relief is a little bit more important to farmers than business property relief, which they also will gain, but of course they'd want agricultural property relief in most cases. Owner landlord, this is where you own the land and you let somebody else use it, and they have to still use it for agricultural purposes, i.e. producing food either directly or indirectly for human consumption, they've got to own it for 7 years in this case. So it's only 2 years if you farm it yourself. It's 7 years if you buy a piece of farmland and you don't farm it. Okay, so those people who've been watching Jeremy Clarkson, who's now decided to become a farmer, that's why he's done it. He's done it so he can get a bulk of his estate, and I think Mr. Dyson is currently buying up most of Worcestershire and Hampshire and Herefordshire in order to get his money out. And he's farming also, so he gets it in the 2 years, not the 7 years. But if you've got it for 7 years, if it's a tenancy, and it has to be a post 1995, because post 1995 tenancies before that date, they were usually known as a sitting tenant, and the 1995 Act was brought in to get rid of sitting tenants. So it has to be post 1995, and it has to be either a proper business lease of some description, or it needs to be a short-term let for grass eating. Otherwise, if it's a sitting tenant or you don't have any agreement at all, then you'll only get 50% relief. So, quick notes: question centres, horse liveries, all of that don't get anything. Stud farms do, and also if you're keeping heavy horses, because heavy horses, of course, are agricultural. So if you're keeping horses, breeding them, or training them, or even selling them, then you will still qualify. Your woodlands, hedges, ponds, I know you're not farming those, but providing they're not a significant part of the farm, then you will also get relief on those as well. But if a large part of your farm is woodland, then you won't get it unless the woodland itself is a commercial woodland. Okay, and that the evidence would be is, did you plant it yourself? Has it been treated? Do you hold licenses to be able to commercially remove the wood? You know, what's your program? If you've had it for 25 years and you've not done anything to it, it's likely that they won't believe it's commercial woodland. So it's a matter of fact, that is. If it's a commercial woodland, then you'll get relief. If it's not a commercial woodland, then you won't. Right, quick one on farmhouses. Okay, so if anybody watches Judge Judy, she always says, if it walks like a duck and quacks like a duck, it's a duck. Well, the Inland Revenue use the same sort of guises on a farmhouse. Okay, you know, if it looks like a farmhouse, you treat it like a farmhouse, and it's known as a farmhouse, usually you'll get away with it. Okay, these are the guidelines straight from HMRC's website, and it says whether the house is the appropriate size and layout to be a farmhouse, well, along with the farm buildings, and you know, it's not a huge big house with little land, you know, then it is likely to be a farmhouse. It's whether it's appropriate in its size and nature. So again, you know, if you've got a mansion house and 10 acres, they're going to argue it's not a farmhouse. You know, it's a house with land, which is how they determine it. They say this is Inland Revenue speak, although it's not possible to describe what a farmhouse which satisfies the character test. You know what if you see one? Well, basically, as I say, if it looks like a farmhouse and you treat it like a farmhouse, and you've got chickens in the garden and sheep, you know, in the kitchen and you know, that sort of thing, then it's likely to be a farmhouse. If you treat it like a mansion house, then it's not. It's whether, you know, the outside people know it's the farmhouse. So do you call it the farmhouse, or do you call it the lodge, or do you call it the hall? It's very important. It's what, you know, what other people perceive it to be a farmhouse, and of course it's how long it's been associated with the farm. So, you know, if you start farming today and start claiming it's a farmhouse, you're going to get challenged. If it's been a farmhouse for the last 20 years and you've been trading as a farm and putting it on your accounts, then you're much more likely to get visited property relief. And as I say, it could be 100% of the farmhouse value, which could be very, very expensive if we get this wrong. Okay, lots and lots of test cases. Some have won, some have lost, but as I say, without looking at each person in itself, we can't give any more guidance. Generically, like this, we would need to have a look at the house itself, and it's how much work you're prepared to do to make it look like a farmhouse. So, just a quick one now then on excluded properties. So, if your business, so we're not talking about hiding a terrace house or a buy-to-let or something in your business, but if your business is one of property, so that's HMLOs, owning industrial properties, then they are specifically excluded from business property relief. Okay, so if you've got a company that owns 10 houses or 5 factory units, and that's all it does, then you're not considered to be trading, and therefore you will not get any at all business property relief on it. Okay. The next one is a little bit more subjective. Holiday lets. Okay. 5 years ago, 10 years ago, I would say you've got holiday let, it's fine, tick in the box. It's a business. Been lots and lots and lots of challenges. In the beginning, the courts were on our side. And they tended to let them through, providing you was doing a little bit. But now, you know, they are not. They're not playing ball. And one of the recent cases I'm going to show you in a minute, where, you know, they were doing much more than just letting out a room, but they still didn't qualify. Okay, so obviously, hotels, bed and breakfast properties, the bed and breakfast, if you've got it part of your farmhouse or part of your house, then it's only the bed and breakfast side which will get relief. It won't get it on the whole house, you'll only get it on a proportion of it. But if it's a hotel or it's a bed and breakfast, and if it's a hotel and you use part of it for your own residence, then of course that bit will be excluded also. But they say that they are providing much more accommodation, and you know, because you get meals there, you know, and do the laundry and do all this. But I mean, a lot of A lot of holiday let businesses are trying to do the same. So I better just show you the next case. Okay, so Mrs. Green carried on. She had got 5 units, and she used to do almost all the work herself. So she used to do all the marketing, the dealing, the booking of guests. She'd provide the linen, the towels, the electrics, the equipment, the furniture. She'd even do a welcome pack for people there, and she'd tell people where to go if there's any problem, and she would take care of them, and she had her own caretaker. The lower tribunal, the first tier tribunal, said, yeah, that's a business. The upper tier tribunal said, no, that's just work that we would say is sufficient for an investment business, and therefore they took the case out and she lost, and all that got hit with inheritance tax. Do I think it's right? No, I don't, but you know, that's what's going to happen. How could she get around it? Well, if she did a bread and breakfast, if she did breakfast meals, then of course she would have taken herself out of the system. And I think that's really where you're going to have to be getting pretty close to for getting inheritance tax relief on that one. So, any questions? Hopefully you'll all get open up. No, Kelly, she's gone to sleep. Okay, I don't think just move Kelly. You're unmuted. Thank you. Hi. Do we have any questions at all on that? Okay. So as I just recap, it's not a big legislation. There's lots of little pitfalls. There's lots of little things that you've got to get right, which is why the idea of making it available for you to start to have a look at. But it's certainly things that if you're trying to get away from paying inheritance tax, because there is no upper limit. If your business is worth £25 million, then £25 million worth of relief you're going to get. So as I say, that's why the Jeremy Clarksons and people like that of this world are looking at it. And so should you. If you've got a business, then obviously you need to speak to me if you're talking about inheritance tax, either now or in the future. Keeping a trading asset is always a good one. So I want to thank you for your time.